Welcome to the Cambridge Financial Podcast with Bert Salazar, CEO at Cambridge Financial Partners, LLC. This podcast is all about tax-preferred retirement planning, economics, financial risk management, and achieving a risk-free and successful financial life. Now, your host, Bert Salazar. Bert Salazar. Bert Salazar.
Hey, good day, everyone. Bert Salazar here. This is episode 141 of the Bert Salazar Show here on a podcast. And today's episode is called Financial Resolutions in 2021 to Maximize Your Retirement Life. So before I start the last podcast of the year, because it's now December 31st of 2020, I want to wish each and every one of you and your families a wonderful, safe, and prosperous, happy new year in 2021. Obviously, 2020 has been a devastating year for many millions of Americans and obviously millions of people throughout the world. So I'm definitely hoping for a much better 2021 for all of us along those lines. So obviously, we all try to do New Year's resolutions, and you've seen what happens with many of those. So what I want to do today is I want to talk a little bit about, what would be some of the critical financial resolutions in 2021 that all of us can take in order to maximize our retirement lives moving forward into the future. So I'm going to break it into two parts. The first part is, why all New Year's resolutions fail, and then part two will be what would be some of the financial resolutions to enhance your financial life and that I would recommend to each and every one of you. So, at the end of the day, all of us have sat down at one point in time or another and talk a little bit about New Year's resolutions and what to do, what not to do, and what to change in your life and so forth. But most financial resolutions and personal resolutions fail. And we always, kind of ask ourselves, why did I put all this on paper and never accomplished a single goal in that given year? And the reason for that is, life gets in the way, and a lot of things are going to happen to you and your family each and every year that is going to kind of throw you off guard when it comes to your personal and financial resolutions. But I can give you what I feel are some of the critical aspects of the reasons why financial resolutions and personal resolutions fail every year. One of the reasons is that Americans' plan resolutions are based on presumed goals and objectives as opposed to outcomes. And what happens is when you start putting goals and objectives on paper, they really look good on paper. And, if you can accomplish maybe 50% of those, you would be doing extremely well in your personal and financial life. The problem is that goals and objectives kind of get blurry along the way, especially after the first quarter of the year. So all of a sudden you start putting them aside and not paying a lot of attention. On the other hand, if instead of putting together goals and objectives, you actually put together outcomes so you can see them, then it's going to be totally different than if you do it the other way. So I can give you an example. I can give you some examples, diet, exercise, money management, savings, business forecasts for those of you that own a business. They all kind of fail during the first quarter of each and every year. Believe me, I've been there many times. I mean, I've been going to the gym steadily for the last 45 years. And I see it every time. When you go back to the gym in January, I usually take the last 2 weeks of December off. And then when I go back to the gym on January 1, it's totally packed. I mean, there are faces that I've never seen before. There are brand new people that are trying to get in shape and so forth. And then what happens is, by the time Valentine's comes around, you start to see less and less people, and then by the end of the first quarter, the same people that have been there year after year and month after month, you will see them there, and most of the others, I would argue most of them, some are going to stick around, but most of them are just going to go away, and then they're going to continue to pay that membership, and then that's how gyms, make money, because they're collecting a membership premium from people that are not using the gym. So, and the same thing will apply to your personal life. So, I think that personal and financial resolutions succeed once you concentrate on the outcomes. In other words, you want to start with the end in sight. So if you can focus on what the end is going to look like, whether it's going to be retirement success, whether it's going to be, what are you going to look like if you were down 30 pounds in 2021, and if you can picture that and think of that as the outcome, then I think you're going to stay a lot more concentrated in hitting your goal, those outcomes, as opposed to working on your goals and objectives. So the same thing will apply on the financial side that we'll talk about in the next few minutes. So those are little things that I can tell you why I see so many resolutions fail every single year. And believe me, I have put together resolutions myself that I have not been able to accomplish. And one of the main reasons why that was the case was because primarily I set them as a goal and objective as opposed to an outcome. So I want to wish you luck for 2021, and make sure you put it in writing, because if you don't put it in writing, then it's a dream, and dreams very seldom happen. And if you're going to put your outcomes in writing, make sure that you can read them every day. Put them somewhere where you can look at them, actually make several copies and put them in different places, in your office, in your home, so you can take a look at them every day, because the more you read them, the more they're going to stay with you in your mind, and you're going to be able to execute. So let's get to it. Let's talk a little bit about financial resolutions to enhance your financial life in 2021 and beyond. One of the first ones that I can give you is to increase your personal savings program with a steady 20% savings rate. I know most people are saying, well, that you should save anywhere between 5 to 10%. That is totally wrong. And the reason for that is people are living a lot longer today than ever before. So you have to be able to save 20%. Now, if possible, make that 20% saving an after-tax saving. So if you can save 20% after tax, you're going to be on top of the world in a very short amount of time, and that would be very critical. Now, if you say to me, Bert, I'm putting 10% of my money into my pre-tax 401k every single year. On top of that, I'm going to save another 10% after tax, and I would say that would be fine. I'm okay with that as well, but try to have a goal of 20%, because when you take a look at taxes, inflation, stock market volatility, interest rate volatility, longevity, and so forth, you have to be able to save 20%. And the sooner that you can start saving 20%, the better off you and your family are going to be. Point number 2 would be that, depending on your tax bracket, diversify your tax savings between the tax-deferred and the tax-free buckets. I would argue that you should make most of your contributions to your tax-free bucket. Now, if you can take advantage of your tax-deferred bucket, because you're contributing to a 401k, you have the ability to do so, and you're also getting a match, at least put 100% of your contributions so you can get 100% of the match, whatever it may be. But when it comes to a 401k, do not contribute more than 7% overall, because there are many other vehicles that may be a lot more suitable for you. And if you happen to have a 401k in which your employer is giving you the ability to put money in on a pre-tax basis, and also on an after-tax basis into a Roth 401k, then maximize the opportunity. So I would argue that you should be, again, depending on your tax bracket, and you can feel free to call me and I can walk you through that exercise, but depending on your tax bracket, you should be making the vast majority of the contributions, at least for the clients that I deal with, to the Roth portion of the account, and not the pre-tax portion. So that would be the tax-free bucket, by the way. Point number 3, to maintain a 20% savings rate, I think it would be important for you to do an inventory of your debt and break it down between good debt and bad debt. If you have a lot of credit card debt and it's a debt that is not deductible, then that would be a bad debt. Now, most debt are bad anyways, but some are better than others. So if you have a tax-deductible debt, I would rather you have a tax-deductible debt than a non-tax deductible. So if you have a mortgage debt, that's a good thing because at least you're taking the deduction on the mortgage interest every year. Obviously, there are certain limitations there as well. But I'd rather you have a tax-deductible debt than a non-deductible debt because, you're just throwing good money after bad money every single month and every single year. So make sure that you do an inventory of your debt. Figure out what, and you may want to do a spreadsheet, put on one side of the ledger, bad debt, on the other side, the good debt, and then try to attack the bad debt first so you can get rid of it. And then obviously you can start working on the good debt because at least you're getting a tax deduction on that. Now, point number 3 for that I can give you, actually point number 4 at this point in time, is make sure that you do a good job in managing your spending habit, and make sure you do so aggressively. The question that I have for many of my clients when they first come in to see me, or for many of you when you reach out to me regarding questions that you may have, I always ask, do you have champagne taste but only have beer money? And this is something that I see often. I see people purchasing and buying and spending above and beyond what their capability is, and that's because they have champagne taste, but they only have beer money. So what I can tell you is that only fools, let me repeat that, only fools waste and spend money for nothing. So hopefully you're not one of those, but if you happen to be a fool, what a better time to start working on not being a fool in 2021 and beyond by really start looking at your expenses. Another point that I can share here with you is, use a debt management program regularly. By the way, you may want to call me or email me for more information on my debt management system. It's one of the best that you'll ever see, and it's going to keep you abreast as to what's going on with your debt and how to pay it years and years in advance, and you can save tens of thousands of dollars in interest payment that would go to someone else instead of keeping it in your personal economy and on your side of the ledger. So those are things that are very, very important. Another point that I would want to make to you, and this would be point number 6, would be a question that I get often asked between leasing versus buying. Now, most of my clients savers, most of the clients that I have that are good savers, they buy automobiles, they buy cars. They don't lease cars. Good savers actually purchase new vehicles every 10 years as opposed to non-savers. Because what non-savers do is they either buy or lease vehicles every 3 years. So if you're leasing a vehicle, you're just renting it. And you're paying that lease payment, that rent payment every single month, for many, many years down the line. So you have ownership of nothing at a given point in time in the future, where if you buy it, you're going to have some more leverage and you're going to have some ownership along those lines. Now, when purchasing a car, I can tell you that, you need to be smart because other than a home, usually the purchase or the leasing of an automobile is the second most highest expense that you have in your portfolio. So, when purchasing an automobile, be smart. Always try to purchase something 2 or 3 levels below your means. And I'll tell you what I mean by that in the next few minutes. Because you don't want to spend at the same level that you're earning income, because then obviously you're just marking time and you're just marking in space and you're not moving forward anywhere. Now, I can tell you that car salespeople are going to try to sell you cars that you don't need for a price that you can't afford, so you can impress people you don't like. Remember, I see this often. I've been doing this for over 30 years. So again, they're going to try to sell you cars for price that you don't need or can't afford, so you can impress people that you don't like. So make sure that you're smart when it comes to purchasing automobiles. Now, always remember that savings equals delayed expenditure. So you're saving today so you can spend it tomorrow, and that's what happens. You put money away in your 401ks, your IRAs, your mutual funds, your real estate. You're putting money away, you're saving, and investing, so that when you get to retirement, all of a sudden, all of those assets will start working for you, and you're going to be spending them down. Hopefully, you're not going to run out of money before you run out of life, but I can tell you, based on my personal experience, that most of you are going to run out of money way before you run out of life. So you need to start saving more, and you need to invest smartly, because otherwise you're going to find yourself in a major problem down the line. Also remember that I always say that your best teacher is your last mistake. So take a look at the last mistake, the last financial mistake that you make, and try not to repeat it. And try to do things that are going to get you to the promised land in the most safe and viable way possible. So remember, the savings equal delayed expenditure, so that's important. So most of the money that you will need in retirement, you haven't earned yet. I don't care if you get to the age of 65 and you have $1 million in your portfolio. Most of the money that you're going to need in retirement you haven't earned yet, because more than likely you're going to live 3 decades in retirement, and $1 million is not going to be enough. So you have to depend on the earnings on that $1 million in order to get you to the promised land when it comes to your retirement. Now, for those of you that have a business, if you're using your car for business and or personal use, make sure that you keep track of your vehicle mileage and expenses for deductibility purposes. Mile IQ is one that I use for myself and in my business, and I normally recommend that to my clients, because it gives you the ability to keep track of all the mileage, and it makes it very easy for you to maintain that, because if you get audited by the IRS, and then you have the ability to show proof of the mileage that you use for business versus personal use. Now, going back to automobile purchases, if you finance your automobile purchases over, let's say, 48 months or 60 months, which would be 5 years, but will trade your automobile every 10 years, then what you should do from year 5 to year 10, keep saving those car payments in a separate account up to the 10th year. And what you will then have is, you're then going to have the leverage to finance your next car properly. Now, one of the things that people ask me all the time, Bert, or they tell me is, Bert, I don't do any type of financing. I always pay cash. And what I can tell you, in a capitalist society, everything that we do is financed. You either pay interest to someone else, or you fail to receive interest on your money by paying cash. So the decision is, well, which one of the two? Then which one of the two would be the better choice? And the answer is, it depends. If the interest that you're earning on your account is higher than the interest that you're paying out to satisfy, let's say, a loan payment, automobile payment, then you're better off financing the automobile, because you do have a positive arbitrage between the earnings rate that you're getting on your money versus what you're paying out. Now, if it's the other way around, then it may be more suitable for you to pay cash and get rid of that debt altogether. But always remember that everything that you acquired in this country is going to be financed. Either you're going to pay interest to someone else, or you're going to fail to receive interest on your money by paying cash. So you have to be very acute to that, because that's important for you to know from an economic standpoint. Now, like I said before, I always recommend that you should try to live 2 steps below your means. Even if you have champagne money, it'd be a good idea to have beer every once in a while. So that's important to note. Now, if you own a business, it would be important for you to hire a virtual bookkeeper, because he or she is going to save you thousands of dollars annually and will help you maximize your business deductions. Now, one of my firms specializes in accounting and tax planning, so we also do bookkeeping for our clients. So if you have any questions regarding that, then obviously you can reach out to me and I'll give you my information at the end of the podcast. And then we can have a good discussion as to, what a virtual bookkeeper can do for you and your firm. If you own a business, can you use the Augusta rule? Let me repeat that. If you own a business, can you use the Augusta rule? And the answer is more than likely you can. I can tell you, but then I would have to kill you. So if you need more information on that, please feel free to reach out, and then we can have a discussion regarding the Augusta rule and how to apply it to your business in order to minimize your tax liabilities while you're enhancing the revenues coming into your personal economy and your pocket. Now, another major point that I'd like to have all of you take a look at for 2021 is, learn the impact of opportunity cost in your financial and personal life. Every time you make a financial decision, there's going to be an opportunity cost. And the sooner you get to understand what loss opportunity cost is, how to apply it in any purchases, whether you're talking about personal purchases or business purchases, then the better off you're going to be when it comes to your life, because it's actually going to change your financial life forever. You will actually become the hunter as opposed to the hunted. So make sure that you get a clear understanding of opportunity cost. Once again, if you don't understand what I'm talking about, feel free to reach out and I'll be more than happy to take a few minutes and kind of walk you through it. If you own a home, make financial expenditures and repairs count. They should increase the value of your home over time. So I know that we all want to do some cosmetics to our home, and some of it is not going to amount to anything, but always take a look at the very beginning of the year. What can you do to your home to make it better and to make it worth more when it comes to a sales price and an equity build-up at some point in time in the future. Now, if you've never done it in the past, start thinking about creating guaranteed cash flow. So you may want to start thinking about investing in real estate. You may want to start thinking about taking a portion of your portfolio and buying annuities that are going to increase your financial cash flow leverage for the rest of your life. So annuities and real estate, they work hand in hand, and they can do tremendous things for you and your family when it comes to your retirement life. And then, one final point out of all these points that I've given you as far as financial resolutions in 2021 and beyond is you have to be able to reinvent yourself. You have to be able to reinvent your life and your business many times. And you should do so as often as necessary. I have had to reinvent my business probably 4 or 5 times in the last 30 years. Now, you don't want to throw the baby out with the bathwater, so what you do is you take a look at your business, see what the industry that you're in is going, and try to figure out how to get there and what are the changes that you need to make today in order to get you to where you want to go in the most viable and most effective way possible. Always remember that life is a moving target, and you have to keep on moving forward every single day. You cannot predict an outcome in the future. All you can do is do proper forecasts, and then make sure that you handle, especially when it comes to your retirement life, that you do it from a risk management perspective, so you can help your family and yourself avoid the fatal 4, which is the risk of dying too soon, living too long, living with a disability, and or living with eroding factors like taxes, inflation, stock market volatility, interest rate volatility, propensity to consume, healthcare issues, and so forth. So be very careful. Life is a moving target, and you got to be able to be quick to the trigger and move with it, because otherwise, if you don't adapt to change, then your business and your family will become a victim of change. So that's all I have for the last day of 2020. I want to thank you all for giving me an opportunity to be in front of you every week. Obviously, for those of you that want to reach out to me, as many of you do, and I thank you for that, feel free to reach out at area code 786-766-1042. You can also send me an email at Bert, B-E-R-T, at bertsalazar.com, BERTSALAZAR.com. And always remember that, for the last 3.5 years, my goal for each and every one of you is always the same and will continue to be the same moving forward into 2021. My goal for each and every one of you is to kind of help you change the way that you see things, because when you change the way that you see things, the things that you see change. So once again, Happy New Year to each and every one of you and your families. Be blessed. Be safe, enjoy this beautiful night coming, and I look forward to spending more and more time with you every single week in 2021 and beyond. Thank you, and have a great day.